Hello, everyone. This is Dr. Duru from Ahan Analytics with the market breadth. Okay, let's start off. We had a wild session of trading today. It's the end of March. It's the end of the quarter. As you can see, the big dominating headline. This is Yahoo Finance. I'm providing this snapshot about an hour and a half after trading closed. Wall Street closes out worst quarter since 2022. That's about as negative as it can be. But anyone who watched the open today has to be wondering whether you're a trader or investor, did we finally get capitulation? This is what all the buyers want to look for is have the sellers finally shaken completely out of the market. Well, there are some signs, encouraging signs, but let's make sure that we look at all of this with an eye of this still being a bear market. And like I've said before, I have an unconventional definition of bear market, which is when the index is trading below its 200-day moving average because it's a much faster indicator. By the time the conventional definition of a bear market hits, which is 20% from the all-time high, that's usually about as far down as the index is going to go. We've had very few historical moments when an index has fallen a lot further than that. So they're very rare. Of course, they're possible, but they're just so rare. Anyway, so this is our snapshot. Of course, headlines are dominated with tariffs, economic troubles. This is an interesting one here. Coinbase has had its worst quarter since the FTX collapse. That's pretty bad. So lots of bad headlines to communicate negative sentiment. What I like to look at first, particularly on a day like this, is market breadth. My favorite technical indicator of market breadth is the percentage of stocks trading above their 50-day moving averages. I call it AT50 for above the 50. Notice, okay, so if you've been following along, if you read my blog, no one should have been selling a thing when the market gapped down this morning. And that's because the market was so close to oversold. It just doesn't make sense. If you wanted to sell, it's kind of what we call too late to sell at this moment. And sure enough, at the open, let me zoom in here. Market breadth opened at about 22.7%. That's about as close to oversold as we got earlier in the month. Now, the hope is, of course, is that the gap down this morning, because it stopped short of the low, that this is a sufficient test and the start of a higher low. But, we have to wait to see time unfold before we know for sure. But anyway, the main message here is that at the open, we got pretty close to oversold. It was a time, of course, you could see since it went up, buyers jumped right into that gap and had at it. Let's look at the percentage of stocks trading above the 200-day moving averages. You can see a similar thing happen. The gap down got close to, but did not breach the earlier March low. So what we want to see going forward is continued buying that will eventually make a higher high and then this higher low, which will be very positive for the bullish case. But again, very early, too early to be talking too much about that stuff. So let's look at the indices, S&P 500. This was pretty impressive. I mean, the market gapped the market makers, I should say, and we should remember who's gapping this market down is the market makers. They're trying to discover what price they can move people's positions around. So they gapped the S&P 500 down right to the earlier low from March. And you could see that sellers freaked out enough to get down a little bit lower than that. So what was this? All the way back, closing in on the September low, and then the buyers took over from there. So this, what I called the bear market area of agitation, still stands as a reference point. We look like we're in for a lot of churn, perhaps, between this low of the area of agitation and this converged resistance between the post-election, sorry, the election day close and the 200-day moving average. And now, of course, the 50-day moving average is converging down. 50-day moving average is the red line. Purple line is where the market closed on the election day in November. And the 200-day moving average is still barely moving up, but it's the blue line here. Okay, so that's the setup for the S&P 500. Let's take a look at what happened intraday. I just want you to show how impressive this recovery was. You can see that after the first 15 minutes of trading, so you have the gap down and then you have the herd that gets freaked out, sells, and then after 15 minutes, the buyers took over. You can see pretty much mostly up ticks for the rest of the day. That is as good a signal of capitulation as we can get because the S&P 500 didn't even stop at the gap. It just kept going right through. So that's one case for that for this being a sustainable low. Again, I'm not going to call this the low because as long as we're in a bear market, there's no true support. But this hopefully is finally a as sustainable low as we got in early March. Let's take a look at the NASDAQ, which is in much bigger trouble than the S&P 500. As I mentioned in previous post, I think that the ultimate risk, downside risk, is coming back to this black line, which is the former all-time high from November of 2021. The gap down, got us maybe a third of the way there before buyers took over. You could see the trouble that the Nasdaq is still in. It failed to, while the S&P 500 gained for the day, the Nasdaq failed to quite finish closing that gap and ended up down marginally. Most importantly, it closed at its new low for March. And it's looking like, unless buyers step in and follow through tomorrow, this could be a new resistance line. So that's very important to watch. Is the previous March low, going to be now resistance for the NASDAQ? And of course, the longer that resistance holds, the more the rest of the market is likely to come down with it. And then we had our small caps, which of course mirrored the NASDAQ. At its low, the gap down, the market makers gapped it down right below the March low. Buyers did step in, but they couldn't quite keep this gap closed. And so IWM, the ETF of small caps, closed at 0.5% down. This bear market line, this is the conventional definition, 20% below the all-time high, still hangs out here, beckoning for a retest. I think at some point this will get retested. Still, I like trying to play for the bounces, so I added to my IWM call option. And of course, let's take a look at the volatility index. Let me just make sure I'm looking at logarithm. Okay, great. This is another sign that we could have had capitulation. VIX gapped up higher, of course, but then it faded throughout the day. It still closed positive. So the bears and the sellers are still hanging on, but still, I would have preferred this gap up to be up to the previous high before falling down. So I'm not entirely confident. So whereas the S&P 500 gave a convincing case for a capitulation day, the volatility index, the VIX, did not. Overall, what I want to see is just more buying. So, for instance, if we gap up, if we get some sort of strong buying follow through Tuesday, turnaround Tuesday, I will be a lot more confident in the sustainability of this latest low. And then finally, let me just take a look at one stock before I close this out. Accenture. This is the kind of chart I'm going to be looking for today as I go through my scans. This is a nice bullish engulfing pattern where the stock gap below the previous day and closed much higher than the previous day's highs. This is essentially at the end, well, what could be the end of a big downtrend. I like Accenture because of their growing AI business, even though they do have government contracts. The generative AI business seems to be pretty good. So and then of course, if I zoom in here, you'll see that it just made a marginal post earnings high. This was the earnings day here. Accenture lost a big 7.3% on that day. So it's looking good to at least continue the rebound to the 20-day moving average resistance. I'm looking for it to close this earnings gap. And once that happens, then we next will have a rendezvous with converging resistance from the 200 and 50-day moving average. All that to say, a stock like this gets on my buy list because of this nice bullish engulfing pattern, which may be signaling a sustainable low for the stock. All right. So that's all I have for today. If you want more of these kinds of quick market updates, subscribe to my YouTube channel. You can always get more details in writing on my blog at drduru.com/122, all letters. And then to help the algorithms find this content, share and like and put your comments and feedback down below. Thanks a lot for checking it out, and I will see you the next time.